Hey guys, this is Mrs. Webb. So, we are talking today about Chapter 6, and that is creating our worksheet. So, we're taking that information. This is kind of crazy because they end up, they give you your cash systems in chapter 4, but chapter 6 or in chapter 5, but chapter 6 goes more along the lines with the end of chapter 4. So at the end of chapter 4, just a quick recap, you're updating all the individual accounts with the postings, you're done with all of the transactions, you're updating all of those accounts. And now this worksheet is our first report. So what we're doing is we're taking all of those individual accounts, and we're putting them on a one page. So if we were to actually have a physical ledger in front of us, it would be multiple pages. So we're actually taking all of that information from those multiple pages and putting them into one sheet called the worksheet. This is going to be our starting point for all of our end of the period activities. So we're going to use the worksheet to create our income statement. We're going to use the worksheet to work on our changes in stockholder and our changes in owner's equity. And we're going to use that worksheet to do our balance sheet. So we're just going to go through the PowerPoint real quick. So the worksheet has, I usually do it in about 10 steps or, something like that. And so we're just going to go through how to create this report. So the biggest thing that we talk about, and this is one of those accounting concepts that we get along with our matching expenses and revenue and expenses and our going concern, is that we are going to be consistent. We're going to be consistent in what we do. So that's the accounting concept that called consistent reporting. So we're going to do the same procedure, the same steps over and over and over again. So we're not going to change it up. We're going to keep how we do each step consistent. And so that's what this consistent reporting is. If we change it up every single time we do something, it's not going to give us accurate information about our business. And it's not going to give us accurate information that we can share with other people about our business, like the bankers and the investors and things like that. So the more consistent we can be, the better it is. So in accounting, there's something called a fiscal period, and it depends on the business. Some small businesses like sole proprietorships, which is what you're learning about right now, those sole proprietorships might do a fiscal period of a month. They could do a fiscal period of a quarter. They could do a physical period of a year. And physical period just means 12 consecutive months. So our calendar year, right? Our calendar period is January through December. Now that will change. Our physical period for businesses will change depending on the type of business. A ski resort, their physical period might be September through August, because it just has to be 12 consecutive months, but they start their busy season getting prepared and ready and stuff in September. So it all just depends on the business. So when you guys are working on your final and things like that, you're probably just going to have a fiscal period of just 1 month. So, and that's typical for a small business because you want to see how you're doing each month, because you want to make sure that you are making a profit each month. So, like I said, we're going to use the worksheet, and that worksheet is going to have a list of all of our accounts on it. It's going to have all of their ending balances as of the transactions. So, at the end of the month, we're going to update all of those individual accounts by posting, and then we're going to use those numbers to start the end of the period information. And that will help us calculate that net income or net loss for the period. So our first step is preparing the heading. So it's always the who, what, and the when. All right. Those are our 3 steps for the heading: who, what, and when. So our who in this case is Delgado Web Services. Our what is the worksheet. And our when, because we're looking at a whole period, right? We're looking at a period, a physical period. And they're doing it for the month. So it says for the month ended January 31st, 20, whatever. So if we're looking at one specific day, it would just be January. But since we're looking at what happened over the whole month and all of the income and all of the expenses that were paid during that month, we're going to it'll say for the month ended. So if this was a quarter, it'd say for the quarter ended. If this was for the whole year, it'd say for the year ended. It just depends on the fiscal period. So that's step number 1. Step number 2 is to write down all of the accounts and their ending numbers from the ledger. So we're going to take all of those final balances that they have in the ledger and we're going to write them down. If they're a debit, we're going to write them down as debit. If they're a credit, we're going to write them down as credit. And so that's step number 2. Step number 3 is to total them. So notice this line. Remember, there's always that rule. The single rule means that there's going to be a total after it. So once we have our totals and we know that our debits still equal our credits, because remember we still have to do that. Our debits still have to equal our credits. Once those 2 numbers are verified, then we can double underline. So this shows step number 2, writing the accounts and the amounts. And then step number 3 is the total, making sure that our debits equal our credits. So this is our starting part of our worksheet. Okay. There's a couple other columns. So we've got 2, 4, 6. We've got 6 more columns coming. So after we've done those totals, now we're going to get to the part where we have to deal with accounts that have to be adjusted. So those adjustments are for accounts like supplies and prepaid insurance. So we're going to add 2 new accounts we're going to add 2 new accounts. We're going to use them, called supplies expense and insurance expense. So this is why we do these adjustments. We've talked about previously our prepaid insurance. So our prepaid insurance, the reason why it's an asset is because we use cash in order to purchase it. So if we have purchased a 6-month period of insurance, and at month 3 we get an offer from a different insurance company for cheaper, I'm going to go back to that insurance company that I paid for 6 months, and I still have 3 months left. So I'm going to ask them for a refund, which means I'm going to ask them for cash back. So I'm going to ask them for a refund for those 3 months that are left. So that's why we have that prepaid insurance as a asset. And we are going to do these adjustments because we're prepaying for them. That means we're paying all up front. So as we use that money goes away. So as we go from month 1 to month 2, we're using that money. Even if we haven't done anything, most of the time you won't even use your insurance. But after month 1, that month the money goes away. Month 2, that money goes away. So you only have, as you go, it reduces the value of that money that you have prepaid. I hope that makes sense. So in order to do these adjustments, we're going to use that, accrual basis of accounting. That's going to be a question you're going to see all throughout. And I know that you guys, we've talked about GAAP before, our generally accepted accounting principles. There's a huge book that's created by FASB, and then they have all of the rules and regulations that you have to follow as an accountant. And part of those are those generally accepted accounting principles, that this is how we do things. So our first adjustment is our supplies account. So we're going to start every single month with a certain amount of supplies. And remember, supplies are things like pencils, pens, cash register tape, toilet paper, staples, staplers, printer paper, that kind of stuff. So we are going to start the year or the month with a certain amount, but at the end of the month, we should have used some of that. And that's what the adjustment is. It shows the used portion of those supplies and insurance. So we have our supplies account that shows our amount that we've purchased, and then our supplies expense account is going to show the amount that we used. So we started the month with $620 in supplies. We used $530. Okay. This is where my adjustment is, and they label it A because there's only two. So we always label A, B, or one. We don't usually use numbers because the numbers could get confused with the numbers in the thing. So we usually use letters. That's why we use A, B, C, D. So we used $530, right? I always tell the kids, when we start with 10 rolls of toilet paper, we better not end with 10 rolls of toilet paper, because that means someone's not using someone's not using toilet paper. So we should always end with less. And that's just the way it is for supplies. We're always going to end with less. So, think about toilet paper. Okay? Just giving you a visual. So we used $530. So that leaves us with $90 here as a new balance in our supplies account. And that supplies expense account has what we used. So it has that same amount that we adjusted. Notice it says A. Our debits still have to equal our credits. And then this gives us a new balance of $90. Okay, so we're going to do the same thing. So this is what it looks like. We're only going to have 4 accounts adjusted here in the worksheet. So after the trial balance, this is what it looks like. So this is my beginning balance of supplies, that we had total of what we've purchased through the month. And then this is what I used during the month. So this is going to update. So notice in the trial balance, there's no number here for supplies expense. That's because it didn't start with a number, but now it has a number. So now it's going to have a debit because it's an expense. Expenses are debits. And so there's going to be my debit and my credit. We're going to do the same thing for prepaid insurance. Prepaid insurance has an amount. Okay. And every month they tell us, okay, every month we're going to deduct $200 or $300, depending on how much money we paid and for how long. And then we're going to figure out how much we used for that month. So in this case, our adjustment, notice it's labeled B. Our adjustment is $150. So we used $150 of it. So we have $750 left. Okay. That's what our ending number in prepaid insurance is going to be, $750. And then our insurance expense, because this is what's used, is going to have that $150. So there's my debit, there's my credit. All right. So, and then this is what it looks like in the worksheet. So here's my beginning number, my trial balance. Here's my adjustment. Notice it's credit because it's less, right? A debit and a credit. We have to subtract. And then notice our insurance expense didn't have anything in there before, and now it does now. Okay. So this and the adjustments, this is step 4. So doing the adjustments, I would put it into as step 4 and 5 because we're going to total that column. So these only have 4 numbers in them total because we only had to adjust supplies and supplies expense, and so we're going to use insurance insurance expense and supplies expense. So once we have those 4 numbers in and we've totaled them to make sure our debits equal our credits, we'll double underline that. So this is going to be step 4 and 5 to get those accounts adjusted, and then those totals. All right, so now we're on to the next. Now we're on to the next column, set of columns, and that's for our income statement and balance sheet. So the last two sets of information. Now, we're the income statement and the balance sheet are going to be reports that we're going to be creating from the worksheet. So we're taking this information from the worksheet and we're going to be putting it into creating reports for our income statement to show how much money we made or lost, and then we're going to create that balance sheet. So in the balance sheet, they want us to work left to right and then top to bottom. So they do the balance sheet first because they're going to extend all of those balances. So this is going to be step 6, right? So we're going to extend all of our balances. Notice we're taking the trial balance. Since there was nothing in the adjustment, that number just gets extended to the balance sheet. So this is what gets extended to the balance sheet: our assets, our liabilities, and our owner's equity. Okay? Those are the three things that get extended to the balance sheet: assets, liabilities, owner's equity. So all of our assets got extended. We had a couple of adjustments here. So remember, we said we started with 620, we used 530, and so that left us 90. We started with 900 in insurance, we used $150, so we have 750 left. And then let me move me off the screen. And then we have our accounts payables, our owner's equity, and then our drawing account. So whatever they are over here, that's what they're going to be over here. Okay, so this is what we call extending the numbers. So we're going to extend those numbers. So this is step, what did I say? 5. So this is step 6, right? I think. So 1, 2, 3, yep, 4, 5, 6, yep. Step 6. So once those balance sheet numbers are extended, now we're going to do the same thing for the income statement. So notice these are all the top accounts. So all the bottom accounts are going to end up on the bottom of the income statement. So look at this. We're going to go to the next. Come on, go to the next. Okay. Now, here are all the bottom accounts. So we start from income summary down. Here's our revenue and our expenses. Okay. So our income statement, our revenue and expenses are going to tell us how much we made, right? That's our sales. And then how much we paid out, which is our expenses. So we are going to take the information and we're going to add up all of our expenses. Okay, here it is. Here's the completed worksheet. So here's all of our income statement information here, and then we're going to bring our totals down. So notice our totals here matched, The first set of totals don't have to match, and they're not going to because we need to know how much money we made or lost. So what we're doing is we're going to take our revenue, we're going to subtract out our expenses, and we're going to get a number. Okay. Then we're going to do the same thing over here on our balance sheet. We're going to add up all of our assets plus our one drawing account. We're going to add up all of our credits. So we're going to add up all of our debits, add up all of our credits. We're going to subtract those two. And notice my two numbers equal. And they have to equal. So I always look at it. Oh, I wish I could pop this back up. Let me see if I can pop me back up. Probably not. I can't remember how to do that. So anyway, I look at it as like your 4 fingers. Okay. Your outside finger and your your index finger and your pinky finger. If you put your middle 2 down, they look like longhorns. Those Texans know this, longhorns. Okay. But if they're outside, I'm party on Garth. We're like, woohoo, we're rocking it out. It's a good thing when they're both outside, on the outside. Okay, so that is what we call a net income. So if those two have to match. Like I said, these two numbers have to match. And then we just bring down their final totals. Notice we single roll again. We're going to bring down these final totals. These two now match, and these two now match. So the numbers are going to go under the lowest number between the two. So I think we have an example of what a net loss looks like. So this is what a net loss looks like. A net loss puts the two the middle finger and the ring finger together. And if you look at your fingers and you put those together and you put those up, I use those to wipe the tears, because that is what, if I'm losing money, I'm crying, right? Because that money's going to have to come somewhere. And as a sole proprietor, that's my money. That it's going to have to come out of my own personal money in order to keep my business going. So the two outside fingers, woohoo, party on, Garth. That's good, net income. The two middle fingers of those, the middle finger and the ring finger together, that's what we cry. All right, that's our net loss. So notice the lower numbers are the ones that are on the inside. Okay, that's just what it net loss, what it looks like. So once that is done, once the worksheet is prepared, then we have to journalize those adjusting entries, those two transactions. So we're just going to put it in. This is what it looks like in a T account. In the journal, it just looks like this. We label it adjusting entries. Supplies expense will go first because it's a debit, and supplies will go as a credit. We have to do this because we have to update those accounts to match what is in the balance sheet. So we're going to, and what's in the ledger to start us off with our new amount for the next month. So this is what the adjusting entry for supplies and supplies expense looks like. This is what the adjusting entry for insurance and insurance expense looks like. And then once that's done, previous. Once that's done, all of those accounts, notice normally here we would write adjusting entry here because it is special. It's different. And so notice you see the credit here and the 90. We'd write adjusting entry here. MindTap doesn't like that, but when you're doing it by hand, any type of, special thing where a correcting entry, adjusting entry, or anything has to go here. And then you see my 750, and then you see these two are updated. So it'd be adjusting entry here, adjusting entry here. So you would see them now. These two now have a balance. Okay. And they won't keep that balance for long. All right. So that is chapter 6. So now we're going to show you how to actually do those steps. All right. Have a great day, guys, and I will catch you later.